Hello fellow traders. Today we'll explore how elections can move markets. We'll look at past trends and key sectors influenced by government policies. As traders, we aim to interpret these insights into actionable trading strategies. Today we'll get into understanding market trends after elections by a pajama trader. Give this a like and subscribe. Let's get into it. Post-election market insights. What traders should watch. Elections can significantly affect market sentiment. Explore how past elections have influenced markets and sectors, and identify what matters most in the current landscape to stay ahead. Historic market reactions to elections. 2008, the Obama administration. Financial crisis recovery, volatility in financials, and a boost in healthcare and tech sectors. 2012, the Obama administration. Moderate market growth with stable policies. 2016, the Trump administration. Rally post-initial volatility due to tax cuts and deregulation. 2020, the Biden administration. Pandemic uncertainty with a tech rally as digital sectors surge. And 2024, the current Biden administration. Early observations on this sector shifts and market responses. Let's look at previous elections to understand the typical patterns. Each administration focus shaped certain sectors, giving us insights into potential moves today. For example, Obama's 2008 win saw growth in healthcare due to the ACA, and the Trump 2016 win drove financials higher from tax cuts. Factors influence post-election market moves. Policy expectations. Possible changes in regulation tax policies in healthcare. Sector sensitivities. Policies impact sectors differently. Example, energy and financials. Consumer confidence. The impact on consumer goods, housing, and retail. And interest rates and inflation. Fed's policy adjustments affect growth and spending. Each election sets new expectations around regulation, taxes, and spending. These can make certain sectors appealing and others risky. As traders, we need to assess what policies are likely to change and identify what sectors will benefit. Sector analysis. Key sectors to watch. Energy. Potential shifts between fossil fuels and renewable energy investments. Tech. Anticipate regulatory focus on data privacy and global competition. Healthcare. Policy on spending, drug pricing and insurance. And infrastructure. Stimulus and development priorities may lead to growth. Key sectors offers insight into potential growth or volatility. For instance, if a new administration pushes renewables, we might see gains in green energy stocks. For healthcare, regulatory shifts can impact biotech and pharmaceuticals. Historical post-election winners and losers. 2008, healthcare, ACA, and green energy as early Obama priorities. 2012, continued steady growth, tech and infrastructure are stable. 2016, financial stocks like JPM and Goldman Sachs surged from deregulation expectations. And through 2020, tech like Amazon and Zoom thrived amid pandemic shifts. And then as of this year, observing early winners in infrastructure and energy sectors. Historical trends show sectors prospered post-election. In 2020, tech exploded as remote work surged. In 2016, financials rallied on deregulation promises. These historical outcomes offer clues to what we might expect this year. Economic indicators to monitor post-election. GDP growth measures economic expansion influenced by policy. Interest rates and inflation. The Fed's stance may change depending on government spending. Jobs data. Imports, consumer spending, real estate, and retail sectors. Consumer sentiment index reflects market confidence and spending willingness. These economic indicators often shift post-election. Watch GDP for growth indications and interest rates for Fed guidance or on inflation. Jobs and sentiment data helps us gauge consumer confidence and possible moves in retail or housing stocks. How to adjust your portfolio post-election. Diversity across sectors reduces sector-specific risk. Stay agile. Be prepared to adjust as new policies impact different industries. Focus on fundamental strength. Quality companies remain resilient. Use historical patterns as guideposts. History offers clues, but stay flexible. Adapting your portfolio post-election is about balance. Don't put all your eggs in one basket. Spread out across sectors. Quality stocks and resilient sectors can help weather potential policy shifts. Trading strategies post-election. Short-term volatility plays. Sector-focused ETFs for rapid market shifts. Long-term growth focus. Companies aligned with new policies. Risk management. Use options, set stop-loss orders, and consider hedging. Monitor Fed announcements. Rate changes heavily impact overall trends. For trading strategies, consider using ETFs to capitalize on sector trends, especially in high volatility. For longer horizons, identify companies that are likely to benefit from policy changes. Manage risk carefully. Hedging and stop-loss orders are key in uncertain times. Concluding insights. Elections bring both opportunity and risk. Historical trends offer insight, but adaptability is crucial. Focus on policy, sector shifts, and economic indicators for strategic trading. To wrap up, elections provide a framework to anticipate market shifts, but flexibility is essential. Policies may offer and benefit in certain sectors, and tracking these trends is key. Remember, history informs our actions, but doesn't guarantee future results. Thanks again for watching.